Everyone thinks they understand what's happening with AI and the NASDAQ right now. The stock market is exploding. NVIDIA's up over 400% in the last year. Microsoft, Google, Meta, they're all printing money. Everyone's screaming bubble. Everyone's comparing this to .com. But here's what nobody can explain. If this is really a bubble, why are the companies driving this surge, posting record revenues, expanding profit margins, and fundamentally changing how the entire global economy operates? So I spent the last 3 months digging through earnings reports, analyst calls, infrastructure spending data, venture capital flows, and productivity studies that most people will never read. And what I found is nothing like the story the financial media is selling you. Here's the problem. We're watching the NASDAQ climb to levels that should terrify anyone who remembers the year 2000. The valuations look insane on paper. Price to earnings ratios that would make your finance professor cry. And yet, these companies aren't speculative startups with zero revenue burning through cash. They're generating hundreds of billions of dollars in actual profit. They're building infrastructure that's replacing human labor at a scale we've never seen. So how is it mathematically possible for this to be a bubble when the underlying economics are fundamentally different from every bubble in history? My name is Tom, and I spend way too much time thinking about market cycles, technological revolutions, and whether the financial world is lying to us or just doesn't understand what's happening. If you're someone who's sitting on cash right now, terrified of buying at the top, or you're already invested and wondering if you should sell before everything crashes, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because what I'm about to show you is going to completely change how you think about AI, the NASDAQ, and where your money should actually be. Let me lay out what everyone believes right now. The obvious explanations for why AI is supposedly a bubble. First, valuations are too high. Companies are trading at multiples that seem disconnected from reality. Second, there's too much hype. Everyone's talking about AI. Every company is slapping AI on their earnings calls. When your uncle at Thanksgiving is asking about ChatGPT stocks, that's supposed to be the sell signal, right? Third, history repeats itself. We've seen this movie before with the .com crash, with the housing bubble, with crypto. When things go up this fast, they always come crashing down. These are the arguments I see everywhere. On Twitter, on financial news, in comment sections. And look, I get it. These concerns sound reasonable. They sound smart. But here's the thing. None of this actually explains what's happening when you look at the data. Let's debunk these one by one, because this is where people are getting the entire story wrong. Valuations are too high. Okay, NVIDIA is trading at about 65 times earnings right now. That sounds absurd until you realize their earnings grew 122% year over year in their last quarter. When a company is doubling profits annually, a high PE ratio isn't a red flag. It's the market pricing in continued exponential growth. Compare that to Pets.com in 1999, which had a price to sales ratio of 32 times with zero path to profitability. NVIDIA did $79 billion in revenue last year, with net margins around 53%. That's not speculation. That's a money printing machine. Second, too much hype. Yes, everyone's talking about AI. But unlike the .com era, where companies added .com to their name and watched their stock triple, AI companies are actually deploying technology that's replacing workflows right now. Microsoft reported that GitHub Copilot is writing 46% of code for developers who use it. That's not hype. That's measurable productivity gains. Google's AI overviews are changing how 3 billion people search. Meta's AI advertising tools increased their ad revenue by 31% year over year. These aren't promises. These are deployed products generating revenue today. Third, history repeats itself. This is the most dangerous assumption because it sounds so wise. But here's what most people don't realize. Every technological revolution looks like a bubble until it isn't. The railroad boom of the 1800s. Most railroad companies went bankrupt, but the infrastructure they built created the modern economy. The .com crash wiped out trillions, but it gave us Amazon, Google, and the internet economy that's now worth over $30 trillion globally. The question isn't whether there will be casualties. There always are. The question is whether the underlying technology is real and whether the leaders are positioned to capture the value. And with AI, the answer to both is yes. So something else is going on here. The narrative that AI is a bubble is missing the actual story. And that story is a massive reallocation of global capital toward the companies that control the infrastructure of the next economic era. This isn't a bubble, it's a changing of the guard. Here's what's really happening. AI isn't really about cool chatbots or generating images or making your emails sound nicer. It's an infrastructure revolution disguised as a consumer technology trend. The companies leading this aren't selling software. They're building the computational foundation that every business on Earth will run on for the next 30 years. And the financial world is only just beginning to understand the magnitude of what that means. Let me show you the numbers that nobody's talking about. Global spending on AI infrastructure is projected to hit $628 billion by 2030, not in some distant future, 6 years from now. That's data centers, chips, networking equipment, energy infrastructure. And who's capturing that spending? NVIDIA controls roughly 95% of the data center GPU market. Their own 100 chips are selling for $25,000 to $40,000 each. And companies are buying them in tens of thousands. Elon Musk's xAI just ordered hundreds of thousands of NVIDIA GPUs for a single training cluster. That's a multi-billion-dollar order from one company. But here's where it gets really interesting. This isn't just about selling chips. It's about controlling the entire stack. Microsoft has invested $13 billion in OpenAI and is integrating AI into every product they have. Office 365, which has 400 million paid users, now has Copilot built in at $30 per user per month. Do the math. If even 20% of those users adopt Copilot, that's $2.4 billion in new annual revenue from one feature. Google is doing the same with Workspace. Meta is using AI to make their advertising so effective that small businesses can't afford not to use Facebook ads anymore. Their average price per ad increased 24% last quarter, while impressions grew 21%. That's pricing power. Amazon Web Services is offering AI infrastructure to every company that doesn't want to build their own. AWS did $90.8 billion in revenue last year and is growing at 17% annually. Their AI services are now the fastest growing part of their business. What you're witnessing is the biggest technology companies in the world embedding AI so deeply into global business operations that opting out will be like trying to run a company in 2024 without using the internet. And here's the political and structural engine that makes this unstoppable. These companies aren't just competing in a free market. They're actively shaping the regulatory environment, the talent pool, and even the energy infrastructure to ensure they maintain control. NVIDIA has exclusive partnerships with every major cloud provider. They've created a moat so deep that even if a competitor made a better chip tomorrow, it would take years to build the software ecosystem and customer relationships to compete. That's not luck, that's strategy. Look at how Microsoft positioned themselves. They didn't just invest in OpenAI. They structured the deal so that they get 75% of OpenAI's profits until they recoup their investment. Then 49% ownership after that. And OpenAI's models run exclusively on Microsoft's Azure cloud. So every time someone uses ChatGPT, Microsoft is collecting revenue on the compute. When a business builds an AI application using OpenAI's API that's running on Azure, Microsoft turned a $13 billion investment into a structural advantage across their entire cloud business. That's a political move, not just a financial one. Google is doing something similar. They're offering AI tools for free or at cost to get businesses dependent on their ecosystem. Once you've trained your models on Google's infrastructure, built your workflows around their tools, and integrated their APIs into your products, switching costs become astronomical. It's the same playbook they use with Gmail and Google Workspace. Free until you're locked in, then they control pricing and access. Now let's talk about the marketing and narrative strategy that's driving adoption at a pace we've never seen before. These companies aren't trying to sell you AI tools. They're selling inevitability. They've positioned AI as something you either adopt or get left behind by. And that psychological framing is everything. Think about how Microsoft markets Copilot. They don't say, here's a nice productivity tool. They say, your competitors are already using this. If you're not, you're falling behind. That's fear-driven marketing, and it works. Salesforce reported that 78% of workers believe AI will help them spend less time on administrative tasks. That's not Salesforce convincing them. That's social proof. Once enough companies adopt AI tools, not having them becomes a competitive disadvantage. And here's the genius part. The technology is good enough that it actually delivers on the promise. When a sales team uses AI to automate lead scoring and email outreach, they actually close more deals. When a customer service team uses AI chatbots to handle Tier 1 support questions, they actually reduce costs. The ROI is real and measurable. So companies that adopt early see results, tell other companies, and the flywheel accelerates. But the real marketing magic is how they've framed AI as inevitable progress, not as a choice. You don't hear, should we adopt AI? You hear, when are we adopting AI? That shift in language is everything. It removes the question of whether this technology matters and turns the conversation into a race to implement. And once that narrative takes hold, capital flows in one direction, toward the companies that control the infrastructure. Meta is playing a different game, but equally brilliant. They're giving away their AI models for free. Llama is open source. Why? Because Mark Zuckerberg understands that if developers build on Llama, Meta controls the ecosystem without having to charge for the model. They'll monetize through ads, through hardware, through data advantages. It's the same strategy Facebook used. Free product, monetize attention. Except now, the product is the AI model itself, and the monetization happens across their entire business empire. Now let's talk about the financial engine and infrastructure behind everything, because this is where the story gets wild. The real power doesn't come from the AI models themselves. It comes from everything happening around them. The data centers, the energy infrastructure, the chip fabrication plants, the talent pipelines, the cloud platforms. This is the most expensive technological build-out in human history, and it's happening right now. Microsoft is spending $50 billion on data centers this year alone. Not over 5 years, this year. Google is spending a similar amount. Amazon's capital expenditures are projected to hit $75 billion. These aren't speculative investments. These are companies printing cash flow and immediately reinvesting it into infrastructure because they know whoever controls the compute controls the future. And here's the thing. These data centers don't just serve AI. They serve every cloud application, every streaming service, every SaaS business. AI is the excuse to build, but the infrastructure has value regardless. Then there's the energy story nobody's discussing. AI data centers consume enormous amounts of power. A single training run for a large language model can use as much electricity as 100 homes use in a year. So what are these companies doing? They're investing in nuclear power, solar farms, and grid infrastructure. Google signed agreements to purchase power from next-generation nuclear reactors. Microsoft is exploring small modular reactors to power their data centers. They're not just building AI infrastructure, they're building energy independence. That's a 20-year strategic advantage. And the chip manufacturing side is equally fascinating. NVIDIA's chips are made by TSMC in Taiwan. TSMC is building new fabrication plants in Arizona with $40 billion in investment, partially funded by the US government through the CHIPS Act. So now you have national governments subsidizing the infrastructure that private AI companies depend on. That's not a free market. That's industrial policy. And it guarantees that the infrastructure gets built regardless of short-term market conditions. The talent pipeline is another moat. The top AI researchers in the world work at these companies. OpenAI, Google, DeepMind, Meta's Fairlab. They're paying machine learning engineers $400,000 to over $1 million in total compensation. They're acqui-hiring entire AI startups just to get the talent. And once you have the best researchers, the best infrastructure, and the most data, you create a flywheel where the best people want to work, where the best work is happening. No startup can compete with that. Let's talk about the psychology that makes this unstoppable. Because even if the technology is real, even if the infrastructure is being built, none of it matters if people don't adopt it. And here's where the social and psychological forces come in. AI has become a status symbol. Using AI tools signals that you're forward-thinking, innovative, cutting edge. Not using them signals that you're behind the times. And in business, perception is everything. I see this in how companies talk about AI on earnings calls. It's not enough to have good fundamentals anymore. You have to talk about your AI strategy. Companies that don't mention AI see their stocks punished. Companies that do see them rewarded. That's not rational market behavior. That's social signaling. Investors want to believe they're backing the future, and AI is the narrative of the future right now. There's also a deeper psychological shift happening. People are starting to believe that AI will make them superhuman, that it will give them leverage they've never had before. A solo entrepreneur can now build a business that used to require a team of 10. A developer can write code 5 times faster. A marketer can run campaigns that used to require an agency. That's empowerment. And when people feel empowered by a tool, they don't just use it, they evangelize it. Look at how people talk about ChatGPT or Midjourney or Claude. They don't say it's a useful tool. They say it changed how they work, that it gave them superpowers. That emotional response is what drives adoption at scale. And the companies building these tools understand this. They're not selling software, they're selling identity. They're selling the feeling of being someone who's ahead of the curve, who's using the tools that will define the next decade. That's way more powerful than any feature list. Then there's the myth-making around the founders and companies themselves. Sam Altman is positioned as a visionary leading humanity into the AI age. Jensen Huang, NVIDIA's CEO, is treated like a rock star at conferences. These aren't accidents. These are carefully crafted narratives that make people want to be part of the story. When you buy NVIDIA stock, you're not just buying shares. You're buying into the narrative that you're invested in the future. That psychological component drives valuations higher than fundamentals alone would justify. But it also creates real momentum that becomes self-fulfilling. Now, let's talk about the dark side, the gray zones nobody wants to discuss. Because as much as this is a real technological revolution, there are uncomfortable truths that should make any intelligent investor at least pause and think critically. At some point, AI didn't just play the system, it started writing the rules. First, the concentration of power. 5 companies, Microsoft, Google, Amazon, Meta, and NVIDIA, control virtually the entire AI infrastructure stack. That's not a competitive market. That's an oligopoly. And history shows us that oligopolies eventually abuse their power. They raise prices, they dictate terms, they crush competition before it can threaten them. We're already seeing this. NVIDIA's GPU prices have skyrocketed because there's no alternative. Cloud computing prices haven't decreased despite massive scale because 3 companies control the market. Second, the energy consumption is unsustainable at current growth rates. If AI adoption continues at the pace projected, data centers could consume 20% of global electricity by 2030. That's not fear-mongering. That's based on current growth trajectories from the International Energy Agency. The environmental cost is massive, and somebody's going to have to pay for it, either through higher electricity prices, carbon taxes, or regulatory limits on data center expansion. Any of those outcomes hurts margins. Third, there's a legitimate question about whether current AI models are hitting diminishing returns. The cost to train GPT-4 was estimated at over $100 million. The cost to train GPT-5 is rumored to be over $1 billion. If each generation costs 10 times more, but only delivers incremental improvements, the economics break down. And we're seeing hints of this. OpenAI's one model is impressive, but not the revolutionary leap that GPT-3 to GPT-4 was. If progress slows while costs continue rising, investors will reprice these stocks fast. Fourth, regulatory risk. Governments around the world are starting to wake up to the power these companies have. The EU's AI Act is the first major regulatory framework. China has its own AI regulations. the US is debating everything from data privacy to algorithmic transparency to antitrust action. Any serious regulation could slow growth, increase costs, or force business model changes. And unlike past tech regulations that took years to implement, AI is moving so fast that governments might actually act quickly out of fear. Fifth, there's the labor displacement issue. AI is eliminating jobs faster than new jobs are being created. Customer service, data entry, basic coding, content writing, these jobs are disappearing. And while that's great for corporate margins, it's terrible for social stability. At some point, there will be political backlash. Whether that's through taxation on AI, restrictions on automation, or something else, the current trajectory where corporations capture all the productivity gains while workers lose jobs is not sustainable politically. And here's the most uncomfortable truth. The companies building AI have massive conflicts of interest when it comes to safety. They say they care about AI alignment and making sure these systems are safe. But they're also in an arms race with each other. The incentive is to ship fast, not to be cautious. We've already seen examples of AI systems behaving in unexpected ways, generating harmful content, or being manipulated in ways the creators didn't anticipate. And the more powerful these systems become, the higher the stakes. If any of these companies has a major AI safety incident, public trust collapses and regulatory hammers come down hard. So where does that leave us? Is AI a bubble or not? Here's my conclusion after looking at all of this. AI is not a bubble in the traditional sense. The technology is real. The revenue is real. The infrastructure is being built. The productivity gains are measurable. This is not pets.com. But that doesn't mean every AI stock is a good investment. It means we're in the middle of a massive capital reallocation toward a fundamental technological shift. And like every technological shift in history, there will be enormous winners and catastrophic losers. The winners will be the companies that control the infrastructure. NVIDIA, Microsoft, Google, Amazon. These companies have moats that are nearly impossible to breach. They have the capital, the talent, the data, and the existing customer relationships. Betting against them is betting against the structure of the entire technology industry. The losers will be the companies that are AI in name only, the ones slapping AI on their marketing but not fundamentally changing their business models, the ones that are too small to compete for talent or too late to build infrastructure. And there will be losers among the leaders too. If NVIDIA's chip dominance gets challenged by custom AI chips from Google or Amazon, their margins could collapse. If OpenAI's models stop improving faster than open source alternatives, Microsoft's investment could turn sour. Here's what most people don't realize. You don't have to predict whether AI is a bubble to make money. You have to understand what's actually happening and position yourself accordingly. If you believe AI is real and infrastructure is being built, you buy the companies selling the picks and shovels. If you think we're in the hype phase and a correction is coming, you wait for the pullback and buy the survivors. If you think this is all nonsense, you stay in cash or buy assets that benefit from AI skepticism. But doing nothing because you're paralyzed by the bubble question is the worst option. Let me give you the actionable steps. First, if you're investing in AI stocks, don't buy hype. Buy revenue and infrastructure. Look for companies with actual AI revenue today, not promises. Microsoft, Google, Amazon, NVIDIA, these have AI-driven revenue growth you can verify in earnings reports. Second, diversify within the theme. Don't go all in on NVIDIA just because it's up 400%. Spread across infrastructure, cloud platforms, chip makers, and application layer companies. Third, understand your time horizon. If you're investing for the next 6 months, AI stocks could be volatile. If you're investing for the next 10 years, short-term volatility doesn't matter. The infrastructure will be built regardless. Fourth, keep cash reserves. Even if AI is real, markets overshoot. There will be corrections. Having cash lets you buy during panic. Fifth, watch the data, not the narrative. Track AI revenue growth, capital expenditures, adoption rates, productivity metrics. Those tell you what's real. Ignore the hype cycles and the fear-mongering. Sixth, Consider the indirect plays. Companies that benefit from AI but aren't pure AI plays. Utilities that power data centers. Real estate investment trusts that own data center properties. Semiconductor equipment manufacturers. These can give you exposure without the valuation risk of the leaders. Here's the thing. The NASDAQ is booming because capital is flowing toward the future. And right now, the future is AI infrastructure. That's not irrational. That's not a bubble. That's the market doing what it's supposed to do, reallocating resources toward the highest return opportunities. The dot-com bubble wasn't wrong about the internet. It was wrong about which companies would capture the value and what the timeline would be. The same will be true with AI. The technology is real. The question is who wins and how long it takes. I spent 3 months on this investigation because I needed to know for myself. I have money in the market. I have a 401k. I have the same fears you do about buying at the top. And here's what I concluded. AI is not a bubble. It's a reallocation of capital toward a revolution that's already happening. The infrastructure is being built. The revenue is real. The productivity gains are measurable. But not every company will win. The concentration of power among a few giants is real. The risks are real. The potential for regulatory backlash is real. But here's what else is real. If you sat out the internet boom because you were afraid of the bubble, you missed Amazon going from $18 to over $180 today, a 10 times return even after the crash. You missed Google's IPO at $85, now over $140, plus all the splits. You missed the entire cloud computing revolution that created trillions in value. The lesson isn't to avoid technological revolutions because there might be a bubble. The lesson is to understand what's real, invest in the infrastructure, and have the patience to ride out volatility. AI isn't going away. The companies building it aren't going bankrupt. The infrastructure isn't getting dismantled. What's happening right now is the foundation of the next 30 years of economic growth is being built. And you have a choice. You can participate in that intelligently and strategically, or you can sit on the sidelines paralyzed by fear that this might be a bubble. I know which choice I'm making. I'm buying the infrastructure. I'm diversifying across the leaders. I'm keeping cash for corrections, and I'm ignoring the noise. Because here's the final truth. AI doesn't succeed because of hype. It succeeds because it's making businesses more profitable, workers more productive, and products better. And now that I've seen how the system really works, how the infrastructure is being built, how the capital is flowing, and how the psychology is driving adoption, I'm not sure this can be stopped. The only question is whether you're going to be part of it or watch from the sidelines. Make your choice. Do your research. And whatever you do, don't let fear of the word bubble keep you from understanding what's actually happening. Thanks for watching. Hit that subscribe button if this changed how you think about AI in the market, and I'll see you in the next one.